Welcome to the Trader's Handbook, a limited podcast series brought to you by IG in partnership with your host, the Finance Ghost. Over the course of our upcoming episodes, we are delving deep into the world of trading, helping both novice and seasoned traders alike navigate this exciting field. Join us as we unravel the intricate strategies and insights that define this dynamic landscape and the beautiful puzzle that is the markets. IG Markets South Africa is an authorized financial services and over-the-counter derivatives product provider. CFD losses can exceed your deposits. Welcome to episode 5 of the Trader's Handbook, and what an awesome podcast series this is turning out to be. Really enjoying it, and so are you, it seems. We're happy with the numbers. It looks like people are opening demo accounts and making their first trades in accounts where it's not monopoly money anymore. So well done to you if you're one of those people, and if you aren't, go and check out the demo accounts and start putting some of the stuff into practice, because of course that is what makes it so fun. And we are recording this week amidst an environment of all-time highs on the JSE. We've had a strong rebound for stocks in general. We've had the rand below 18 rand to the dollar. Things are good in South Africa right now. Sentiment is strong. Most local stocks are rallying. The sun is kind of starting to shine, not so much in Cape Town. More on that to come. But let me first welcome Shaun Murison from IG Markets South Africa, our regular source of knowledge on the world of CFD trading. Shaun, thanks so much, as always, for doing this with me.
Oh, great to be here again. Exciting times in the market, like you correctly said. Rand at its best levels in more than a year. We've had a JSE top 40 index trading to new all-time highs. We're on the cusp of an easing cycle in interest rates, so things are cautiously optimistic, well, actually not so cautiously, aggressively optimistic at this stage. But markets don't move in a straight line, so exciting times ahead. Expecting a little bit of volatility.
They are quite aggressively optimistic. I mean, you're seeing these South African mid-caps now trading at like low to mid-teen PEs, where they were languishing previously at like 7s and 8s. It's quite interesting. I'm sitting with quite a lot of property exposure in my investment portfolio, hoping for these rates to come down and for all of this good stuff to flow into these property owners ultimately, especially on the retail side. So it's going to be pretty interesting to see how the next year pans out. But of course, as I've learned, in some cases the hard way, trading and investing are quite different animals. Now, listeners who have been following the shows thus far will know that one of the positions that I tried out in my demo account was to be short Mr. Price. Now, this was very much based on my view that I don't think Mr. Price is as strong as some of its competitors in that space. I think the valuation had gotten a little bit overcooked. And we're going to reflect on that trade today and what I've learned from it, as well as perhaps a smarter way to actually go about things. But I think before we do that, for those who have perhaps made this their first podcast in the series or still aren't quite familiar with these terms, I think it's always worth just spending literally a minute recapping the difference between long and short positions on a stock, because the beauty of CFD trading is that you can go short. You can't do that in your traditional brokerage account. You can only go long. So, Shaun, I'll let you do the honors on a brief relook of long versus short.
Okay, so long, very simply, it's the same as that you do if you're investing. You want to buy low and sell high, without obviously simplifying things. Obviously, there's the use of leverage in trading, and that's so we talked about the profits and loss being magnified. But when you talk about the short side of things, you also have the opportunity to, when you look at a short, it's taking a trade with a view that you expect that market to fall. So when you're going long, you want to buy low and sell high to make money. When you're going short, you want to sell high and buy low, if that makes any sense. So essentially, in both scenarios, you need to pay less to buy something than you sell it for to make money. It's just when you're going short, you can do it the other way. So if you think that market's expensive, you can take a short position, you can sell it. Basically, you're borrowing shares. If you're looking at shares, you're selling it, and you're hoping if it does come down, you can buy it back cheaper.
So back to the Mr. Price trade. Now, I had what would best be described as a naked short. In some ways, lost my shorts, but we'll talk about that now. And in other words, this is basically an unprotected position of being short Mr. Price. So I'm literally sitting there going, I'm not long any other clothing retailers or not that long South African general mid caps to large caps in case there's a big rally in local stocks. I'm just sitting there short Mr. Price because I believe so strongly in that trade. Easy with monopoly money, and that's why I did it. Now, it looked promising initially. Actually, I was in the green. I think we spoke about that on probably episode 2. I can't recall exactly. And at that point, I should have said, thank you very much. I'll take the profits and run. However, I didn't. And on a naked short, I think you need to be in it pretty much for a good time rather than a long time. You can't be too greedy because you are betting against a whole lot of things like inflation, for example. I mean, this is such an important concept in long versus short, right? Is over time, shares are generally expected to go up over a long enough time horizon. And so there's actually no limit to how much you can lose on a short. Whereas, if you are going on a long position and it goes wrong initially, you can kind of wait it out. But this is monopoly money in my demo account, and I wanted to see how this trade would play out. So instead, what I did is, as that share price moved higher and my short lost money, I added to the short and hoped that, okay, I'll get the right level, the thing will fall over, and the trades will be in the money. Now, that turned out to be a really bad call. If you're naked short and it starts moving against you, I think you need to be very careful of fighting that momentum. The long positions, as I said, they sort themselves out over time, provided the stock is at least going up over the long term. But an ugly short that is going wrong has no limit to how much it can hurt you. So eventually, I got out of the way of it. I locked in a loss in the process. So nice lesson learned there. I think the lessons I took from it were, if you're going to be contrarian, as I was, and as you pointed out at the time, one, you have to be nimble, which is exactly what you said. And two, don't be stubborn and turn a small loss into a bigger loss. If you're going to do something like that and it goes against you, then rather get out of the way. And I would definitely refer our listeners to the episode we did just before this. So that would have been episode 4, in which we talked about what it means to have these different trading strategies, to let your winners run, to cut your losses, or not, as the case may be. But there may well be a smarter way to actually play these valuation dislocations, because instead of a naked short, I could have done a pairs trade, which is quite an interesting way to play the market. And in one of your very recent newsletters, Shaun, you put out an idea for Mr. Price versus Truworths as a pairs trade. And I think before we get into the details of that exact trade, can you just explain for us what a pairs trade is? And then I think, yeah, maybe go into how that trade would actually work.
Just on the short side of what you were saying earlier on, before going to the pairs stuff, you're right. If you are short, there is no ceiling as to how far share can go up. So we have a saying here we call it's better to be long and wrong than short and caught. And I think in your trade you're short and caught.
Definitely short and caught. Definitely. That is precisely what happened.
Because I mean, on the long side, I mean, a share can go to zero, but that means that if you're on the wrong side of that, if you were long, your loss would be kept. But a way of protecting yourself in the market and is basically a hedging strategy. So when we talk about pair trading, we're looking at taking 2 positions instead of 1. So we're looking at taking a long position and a short position. And generally, we'll do it within shares that are quite highly correlated. Shares within the same sector, like gold shares or platinum shares or banking counters, and looking at one that's underperformed a little bit and one that's outperformed. And the one that's underperformed, you might look at a long position, and then the one that's outperformed, you look at a short position, and you view the profit and loss from both those positions together. So you're trading one share against the other rather than just the general macro market environment. In my opinion, it's a bit of a safer way to trade. You are essentially hedged in the market, and where the markets are going up or down, there's an opportunity to make money in that pair. So when we refer to that Mr. Price trade, so going back to you were trading Mr. Price, something that I was looking at in the Technical Tuesday newsletter, which we put out every Tuesday. And it is free for your subscribers if anyone is interested in that. The basic analysis there was saying that it looks like, since the election time, we've seen quite an outperformance of Mr. Price relative to Truworths. Now, they've both been positive. There's been positive sentiment around both companies. Both have rallied. But perhaps, the gains on Mr. Price have gone a little bit too far relative to the gains in Truworths. So we use a little technical indicator here. So I'm using a technical analysis version for approach to the pair trade. It's an indicator called the relative strength comparison. And all it is, it's a ratio. So it takes the share price of Truworths and it divides it by the share price of Mr. Price. And what that was telling me is that, well, Truworths has underperformed Mr. Price a little bit too much over the short term. And maybe going forward, we can see now Truworths start to outperform Mr. Price. It's not saying that I think Mr. Price has to come down and Truworths has to go up. Just saying their relationship needs to normalize. And if it does, then you'll be making money. So at the moment, that suggestion was maybe there was a underperformance of about 8% there. So we're looking to make about 8% on that trade. And it has started moving in the right direction. It hasn't hit the target just yet. Yeah, that's the basic premise of it.
Yeah, and that's very different to sitting naked short, right? Because if I think that there's a company in the sector that is expensive, well, if the whole sector goes up, then that short can still lose money. Expensive things can get more expensive. But one of the ways to protect against that would be to go long one of the low valuation stocks in the same sector, so that if the sector gets the upswing, you would hope that the low valuation stock would get more of an upswing than the one that you're sitting short, and net net you come out with a profit. Would you say it's also quite contrarian then, because you're actually going short the winner and long the relative loser in the sector? It's actually quite contrarian, which must be why I like it, right?
Maybe. It is a bit of bit of a mean reversion type strategy. In technical analysis, there's a lot of talk about trend following, and this is actually just deviating away from the trend following approach in trading. This is a bit of a mean reversion type strategy. We expect relationships to normalize over time, but yes, if we say there is a contrarian aspect to the type of trade, but we are still market neutral, so we're not worried about whether the shares are both going. I mean, are going up or down. We're trading the relationship between the two companies.
Yeah, and for someone like me who believes quite strongly in stuff like mean reversion in multiples and how important valuations are, I think pairs trading becomes really, really interesting and is a superior strategy, I think, to sitting naked short. The other mistake, of course, with that short was to just be naked short into immense South African sentiment, and that was a good lesson learned as well, I think, is again, when you're investing, which is my background, and it's long only and it's longer term stuff, you are often rewarded by being against what the typical sentiment is. You're buying the beaten down thing because you believe there are catalysts for it to improve at some point in the future. And then you look 3, 4 years down the line and you've achieved a compound annual growth rate of 20% and you've beaten the market because you bought something at the right time when no one else wanted the thing. Trading is just so different to that. And, it's a lesson that you've got to learn by doing, which is why I'm so in favor of these demo accounts, because you've got to go in, rather go and make these mistakes in a demo account than making them with real money. And yes, a pairs trade would be a different outcome potentially for me. So I think, Sean, let's go into the costs of a pair trade, because this is obviously really, really important, right? I mean, you've got to look at your net return after costs, because otherwise you might not be making any money at all. So what are the costs of a pairs trade? Because there's actually two legs to this trade. So presumably it costs, well, double roughly, what it would cost you to just go with one leg of the trade. I think let's run through that.
Yeah, so I mean the costs don't change in terms of how IG prices things. So entry level cost commission on a position, you're looking at 0.2% or 50 rand on a trade, and that's each leg. So like you correctly said, when you start looking at a pair trade, you are essentially insuring yourself a little bit in the market. So you're doubling up on your position. So your cost does increase, which is, I suppose, the premium for, uh, I would say, reducing your risk within the market. But so you pay that 0% on both legs. So in that, we just go back to that true as Mr. Price position, you'd be paying 0.2% of what your exposure is, so what the total value of that position is. So it's a 50,000 Rand position, you'd be paying 100 Rand for the trade. But if you've got two of those, so now you've got two 50,000 Rand positions because you've got the short on Mr. Price, that's another 0.2%, and that would be another 100 Rand. And obviously you pay that when you enter the trade, and you're going to pay that when you exit the trade. And obviously, that's your barrier to making a profit.
Look, we definitely shouldn't create the impression that a pairs trade is guaranteed to work, because, of course, what this is now is a trade with two legs. And that means technically, if you get both wrong, you can lose money twice as quickly. So if your short goes against you and your long goes against you. So, in other words, if you believe that, one share is expensive and one share is cheap and that gap should close, but instead it opens, so the winner keeps winning and the loser keeps losing, and you've now gone the wrong way around, that gap can just keep widening. I mean, a great example on the international market would be something like Costco versus Walmart. I can imagine there were many times where someone looked at this and said, sure, Costco's crazy expensive. Walmart is looking cheap in relative terms. Let me go long Walmart, short Costco. And if you'd been sitting short Costco at any point in that journey, you have been absolutely killed. That gap has just opened and opened and opened between the two. It's actually now the biggest I think it's ever really been in terms of the gap in valuation multiples. So that's a very tempting one to say, okay, great, do the pairs trade, but it can just keep going. You just don't know. So, that's obviously a challenge. And one of the ways to mitigate risk that we've talked about a lot in these podcasts is the use of stop losses. They're probably a little bit more complicated in a pairs trade than they are in a normal trade. So I think let's just work through how stop losses work in the context of a pairs trade. Do they work? And is it something that you have to think about differently?
Okay, so when you're trading, I mean, you got to manage your downside risk. We've talked about that at length. And when we talk about a stop loss, it's really about saying, admitting when you're wrong. We're not going to get it right every time, especially when we're trying to tell the future. I mean, that's essentially what we're doing with trading, aren't we? We're trying to tell the future. So in a conventional trade, what you're going to do is you're going to have you'll look at, I want to buy here. If it, hopefully it moves in my favor and I'll look to take profit there. But if it goes against me, where am I prepared to accept that I'm wrong and take my loss? And that's obviously what we refer to as a stop loss. Now, when you're trading on the IG platform, essentially you have the feature of being able to put in a stop loss into the system to automate that process. So you don't have to be in front of your computer the whole time. And if the market, you're at work and the market moves against you, you predetermine your loss and it would kick you out of the trade. Now, when you do look at something like a pair trade, that does change a little bit, does become a little bit more complicated because you don't know how things are going to correlate. So if you're taking two positions, so you've got a long and a short in the market, in a perfect world, you want your long to go up and your short to come down. So you're making money on the long and you're making money on the short. That's what we call double alpha positive. But quite often that's not the case. And it's quite often you'll find that both shares, because they are correlated and what's happening in the macro environment, you might find that they both go up. And in that situation, you want the position that you long to go up quicker than the position that you're short, and so that you make more money from the long than you're losing from the short. And remember, we net those two positions off. Or alternatively, you could have both share prices falling. All right, and in that situation, to make money, you want the short to fall quicker than your long. So you make money on the short, you'd be losing money on the long. But when you net those positions together, hopefully you'd be profitable. Now, when we talk about a stop loss, we don't know in pairs trading, we don't know how that market's going to correlate. So for the example of Truist versus Mr. Price, now that has started to work and has started to move in the right direction, but both of those legs have gone up. So both those shares have gone up. So you're losing a little bit on the Mr. Price short, but you're making on the Truist long. Because you don't know how that's going to correlate, you can't uh, it's hard to just put a stop loss in the system to try to protect your risk. So you should still manage your risk, but I think in a pairs trade, you manually exit the trade. So you might say to yourself, well, I'm prepared to lose, let's say 3% in that trade. And then you just need to monitor that position and then say, okay, well, it's breached my levels. And then you'd exit both trades at the same time. So still need to manage your risk, still need to manage that downside risk. And because we don't know how, if they do revert back to the mean, we don't know how that's going to happen. So, yeah, it's a manual exercise of stop loss in that situation.
And of course, position size is the other great risk management tool, right? It's one thing to have stop losses, but if you go in and you put in this big position relative to not just your portfolio, but also your own ability to potentially lose money. And I think that's maybe a concept that, we don't talk about enough. It's not just relative to the size of your portfolio, it's your sort of value at risk. And, and you talked on the previous podcast about looking at stuff like the volatility in each stock, the sort of average moves that it can make. It's a very nice way to go and assess the risk. Look at those two charts and say to yourself, okay, how much do they typically each move? What is my sort of risk in this trade? And then get the sizing right. I mean, that's got to be another important risk mitigation tool here.
Yeah, so exactly what you're saying. So position size is a function of stop loss. So, you always look at how much we're going to risk per share, but you also need to determine, what is the total risk of your account that you're prepared to risk in any one trade. General guidelines, between 1 and 5% of your account size in any one trade, but it really is up to you. But you have to predetermine that. Obviously, if you're going too big into the market, your position sizes are too big, then you don't give yourself that much breathing room. Now, when you're looking at pair trades, you're going to look at more or less the sort of equal position size. You've got 100,000 position on the long, 100,000 position on the short. If you take smaller positions, and I think if guys are getting started out there, I'd always suggest taking smaller positions and having maybe slightly wider stops, just so that we can actually give those trades a little bit of breathing room, because quite often they don't move immediately in the right direction. Sometimes they go against you before they move in the right direction. Well, if they do move in the right direction, which is obviously the goal.
So speaking of the sort of mistakes that can be made and, me getting it wrong in my Mr. Price short, here's another fun mistake. Always good to learn. So I wanted to do a pairs trade in the last week of short Italtal Lon cash build. So exactly all these reasons, right? Going and picking the downtrodden one, Italtal and cash build. There's a lot of good reasons why they should move together as South African consumer discretionary spending improves, etc., etc. I'm actually Lon cash build in my vanilla equities account for what it's worth. But obviously, to do pairs, you need CFDs. But also, you need both of those instruments to be available. So instead of checking that they are both there, I just assumed they both would be. So I put on the short for Italtal, and then I was rather horrified to find that cash build was not available on the system, which left me, guess what? Naked short Italtal. Yay me. The joy of a demo account and practicing. So why is that the case sometimes where you actually just don't have a stock on the system? Because obviously a pairs trade kind of requires two, as the name suggests. The lesson here being to check both legs of a trade before pulling the trigger. But I think it's good to understand why sometimes there just isn't availability on the platform.
Okay, so when you start trading leverage instruments, you want shares to have high levels of liquidity. And so generally, shares that have lower level of liquidity, um, we won't offer. So, their market cap, their size, just because then perhaps they certainly become a lot more volatile when you're crossing the spread. You can see sharp sudden movements, and it's just a higher risk to the client, and obviously the higher risk to our book. So um, we offer the most liquid stocks, and I don't have the exact figure here, but it's at least 200 of the more liquid stocks on the JSE if you're looking at the local market. Ones that we think are suitable for short-term trading, and it's gauged by risk and liquidity. So there are some securities that won't be available, and they would be those smaller cap shares.
Yeah, that does make sense. So the lesson in this is always check, especially if you're going to do a pairs trade. Don't go and do one instrument and then potentially not the other. So I think, Shaun, this brings us to the end of episode 5. I think it's been another goodie in what is really a great series. I think pairs trading is just a great way to go and express your views on relative valuations and to actually look for the opportunities out there. And you can't do it without being able to go short. And that, of course, means CFDs. So the only way to see this for yourself, honestly, is to get that demo account open. You might think, oh, I don't want to try it, or I'm going to go straight into the real deal. Just look at some of the silly mistakes I've made in my demo account. I can almost guarantee you'll make other silly mistakes or different ones. Maybe you won't, in which case you're lucky, but why take the risk? Go and try it out. Go and get used to the system. Go and make those mistakes without real money. And then you'll know for sure if this is something you want to dabble in, and then you can do it with the stuff that actually counts. So I would also put out there that if you are listening to this series and you've got questions that come up or you wish we covered something, send it through to us. You can contact me on X, what used to be Twitter, or you can, contact me through ghost mail. You can reach out to Shaun on the various social platforms or the team at IG. Like, let us know what you'd love us to cover. There are still several podcasts in this series, and we would love to be responsive to your questions and sort of build them into what we're going to cover. So thank you for listening. We look forward to having you here on the next one, Shaun, and to the listeners, we look forward to welcoming you back for episode 6 when that launches. This has been episode 5. Go check out the others that we have, and thank you very much for listening. Shaun, thank you.
Awesome, thanks.
CFD losses can exceed your deposits. In our gorgeously diverse country, there really is a new reason to trade every day. Current affairs to political news can make the markets move and cause volatility, which can be advantageous to a trader. Diversify your portfolio by opening a trading account with IG and explore the possibilities of CFD trading, or practice your trading skills on an IG demo account.